Today, we're going to unpack one of the most dramatic financial rescue missions in recent African history, Ghana's Great Banking Cleanup. It is a really fascinating story about what it takes to pull an entire economy back from the brink, and wow, the staggering price you have to pay to do it. So, let me just start by asking you a question. What do you do when the very foundation of your country's economy, the banking system, just starts to crumble? For Ghana back in 2017, this was not some hypothetical question. It was a terrifying reality. All right, first things first, let's go back to 2017 to really understand just how bad things were. We're not talking about just a few banks having a bad quarter. This was a systemic crisis that put the life savings of millions and millions of Ghanaians at serious risk. I mean, just think about that language for a second. When your own central bank admits the system is in a near state of collapse, that is a five-alarm fire. And this wasn't just some internal panic either. The IMF looked at the situation and called it Ghana's single most pressing problem. The whole system was teetering right on the edge of a cliff. And this quote from the head of Ghana's central bank, wow, it gets right to the heart of the problem. See, this wasn't just about bad loans or a weak economy, it was a total crisis of governance. He said some banks were literally treating the money you deposit, your money, like their own private property, like a personal piggy bank. So this wasn't just about numbers. It was a fight to protect the life savings of everyday people. So with the system on the verge of a complete meltdown, the authorities, well, they had to act, right? And they acted big. They launched this massive and pretty controversial intervention that came to be known as the Great Financial Cleanup. To really wrap your head around the sheer scale of this operation, you just need to hear one number: 420. No, that is not a typo. 420 financial institutions had their licenses completely and totally revoked. That number is staggering, and it tells you just how deep the rot really was. And look, this wasn't just about a few big-name banks you might see in the city. The cleanup went into every single corner of the financial world. Sure, 9 universal banks got shut down. But look at this, 347 microfinance companies. I mean, these are the places that give loans to small businesses, to local communities. The intervention was incredibly broad, and it went deep. So you might be wondering, how on earth do you shut down hundreds of banks without causing a full-blown panic? Well, the strategy was kind of like financial surgery. Instead of just letting these banks disappear into thin air, their assets and their debts were carefully transferred over to stronger, healthier banks. And in a really crucial move, the government created a brand new state-owned bank, Consolidated Bank Ghana, or CBG, specifically to absorb a bunch of the failed ones. Now, an intervention this big is never, ever cheap. And that brings us to maybe the most debated part of this entire story: the price tag. Just how much did this monumental bailout actually cost the Ghanaian taxpayer? Well, as you're about to see, the answer is surprisingly complicated. Okay, so if you're looking for one simple, clean number here, you're not going to get one. Depending on who you ask, when you ask them, and what exactly they're counting, the figures are all over the place. The World Bank said 21 billion cedis, but just for the banks. The finance minister gave one number, then another. The estimates float anywhere from 16 billion to over 30 billion cedis. The key takeaway here isn't one specific figure, but just the colossal scale of this thing, a cost that's a huge slice of Ghana's entire economy. Which, of course, leads to the next big question. Where did all this money come from? I mean, how does a government pay for a multi-billion cedi rescue practically overnight? The answer is government bonds. Now, if you're not familiar, just think of a bond as a kind of formal IOU. The government issues these IOUs to investors and promises to pay them back later, with interest. And as you can see from this timeline, they did this in waves, issuing billions at a time at these critical moments to fund the entire cleanup. It was basically a massive borrowing spree to find the cash to plug all the holes in the system. But here's the thing, this wasn't magic money. By issuing all of those bonds, the government was simply creating new debt. So the cost of the banking crisis was effectively lifted off the shoulders of the failed banks and placed squarely onto the public's balance sheet. That financial burden was now spread across every single taxpayer in Ghana. All right, so let's zoom out and bring this all together. What's the ultimate verdict on this massive intervention? In this last section, we're going to weigh the undeniable successes against the very real and very long-lasting costs. And really, this is the fundamental trade-off at the heart of the entire cleanup. On one side, the successes. A catastrophic bank run was avoided, the savings of millions of people were protected, and what emerged was a smaller but much more stable banking sector. But on the other side, the costs. A massive spike in national debt, that huge burden shifted onto taxpayers, and yeah, some lingering questions about the transparency of the whole thing. From the government's point of view, this quote from Governor Addison pretty much says it all. Their number one mission was to protect ordinary people, and they could stand up and proudly say that despite all the chaos, that mission was accomplished, without a single customer losing money. And that restored stability wasn't just theoretical. It had real, tangible effects. In the years after the cleanup, the central bank actually felt confident enough to cut its main lending rate down to 15.5%, which was a 4-year low. That's a clear signal that confidence was finally returning to the financial system. But that brings us right back to our final and maybe most important question. There is no doubt the system was saved from a total collapse. There's no doubt that depositors' money was protected. But that stability came at a steep, steep price, a price paid for with billions in public debt. And so we're left to wonder, in the long run, who will ultimately be the one to pay that price?